This is an educational example based on my personal approach. Results vary widely, and nothing here guarantees profit or future performance. Hello, and welcome to the Trading with Ashley show. The title is shocking, but it is a true story, and I am making this video so that I can help those of you that get into credit spreads. There is a way to keep yourself safe. Now, I'm going to share with you what happened to me. So, this was Wednesday. I had a credit spread open on Micron. My strike was very conservative. It was at 725. So that seems like it's going to be an okay trade. Now, I have a rule that when I do credit spreads and it's the expiration date, I always close those before the actual expiration because you never know what can happen after hours. So that was my intent when I actually opened this trade. In fact, what ended up happening that day was I had a meeting an hour before market closed. Now, this is a typical meeting I have with one of my team members. And this meeting usually lasts maybe 20, 30 minutes tops. So I saw the trade and I knew that I was going into the meeting with the trade open, but it was in a safe zone. And I said, I'll just close this trade after our meeting. I'll get it closed out. Well, I was pretty shocked when I heard the closing bell go off, not realizing I had been actually in this meeting for much longer than 30 minutes. And what ended up happening was after the bell, I noticed that Micron was dropping and dropping fast. I think it is part of the unwind that was happening with situational awareness, the whole account blowing up and all the selling that was going on. So my strike price was 725. Now I noticed after hours this thing was dropping. It dropped all the way down to below $710. Now at this point, I'm a little concerned because I had fully intended to, one, exit the trade before expiration, and two, I thought I was at a pretty safe price. Well, I had 75 contracts, which that sounds like a lot, but for an account my size, it actually follows my rules of staying under 1%. So I was concerned. I called my broker and they explained, yes, you do have the protective put. You could exercise it, but there's no guarantee that you're actually going to be put the shares. So if you exercise the put when you don't actually have the shares, then you could be in a more difficult situation. So I really just had to wait. Well, as you can imagine, that was a very restless night. And sure enough, when I woke up, the first thing I did was check my text messages. I get text messages from Fidelity if there's any assignments that took place. To my shock, I was assigned 7,500 shares of Micron at 725. Now, this is over $5 million in capital being used. Now, I don't have $5 million of capital that's just sitting there waiting to be used. I actually use very conservative margin, so I had about a 30% usage of margin, which left a lot of cash, but not $5 million worth of cash. So, of course, I was in a margin call. So basically, what happens when you use margin? You have given the keys to your portfolio to your broker. In fact, they give you a very short window in a situation like this because they don't want to be on the hook for all of these shares. And you have two options. You can either get out of the position or you can add cash to the position. Well, luckily for me, Micron had risen after assignment. Assignment took place at 725. Pre-market, it was trading closer to 800. So I was able to exit the trade pre-market for a very nice profit of almost $300,000, but it's not worth the risk. This turned out very favorably for me, but it could have been catastrophic. In fact, the whole dynamic with situational awareness was that he was over leveraged. Now, he was over leveraged, fully intending to be leveraged. He just didn't expect the market to move against him. And so the lesson here is a very important lesson. Do not go into credit spreads if you're going to be distracted at close and you're not able to close out before the market ends. Anything can happen after close, and then you lose control of the trade at that point. Also, I want you to consider taking profit on your spreads before you even get to expiration. Now, we're going to look at a few different scenarios. I'm going to show you a current spread I have open, and I'm going to show you what a potential exit would be to keep yourself safe. And then if it works against you, how to get out of it without taking 100% loss. I think this will be a very important lesson and one that you might want to save and use as you start to dabble in different trading strategies. Okay, let's jump into the computer so I can teach you how to keep yourself safe with credit spreads. Let's look at the actual assignment. You can see here, 729, I was assigned $5.4 million worth of Micron stock. I'm going to show you, I don't have that type of money in my account. Let me show you what I'm talking about. Here's my actual account. You can see I do have 3.16 million worth of margin buying power, but I'm also sitting on a lot of cash. I am a more conservative trader when it comes to margin, and that does keep me safe. Even though this trade was not a safe dynamic in general, you will see that I don't use a lot of the margin available to me. Now, going back to my MU example, like I said, just as I woke up, I wanted to go ahead and get this problem taken care of. So I started selling. You can see all my different sell orders, which was great because it resulted in almost $300,000 in profit. But again, this could have really been a more catastrophic story if Micron had started working against me instead of moving up after assignment. To demonstrate how to keep you safe on a current open spread that I have, this might be a good example for you to consider. So you can see right here, Apple is the trade. This is a credit spread. It does not expire until December. It is a $300 sold put, and then my protective put is a $295 purchased put. So let's check on the trade. Currently, at the time of recording, you can see that the cost basis was $1.69. So I got $1.69 for this trade when I opened it. Current market value is showing it's gone down a little. That's actually good for me because it's cheaper to buy it back. So this trade right now is in profit $34. It is about a 20% gain at this point. So I'm going to show you one way you can keep yourself safe. So you can see right here, I got $1.69 or $169. When you see the premium right here, it's $1.70. You're just seeing a little bit of commission there. $1.70 was what I opened this trade for. When you see this be cut in half, so something closer to around 85 cents at the current value, that's when you will consider closing at a 50% profit. Let me show you what that looks like for a potential exit. Now, closing it is going to be a debit because you received a credit for it initially if you want to close at 50% profit. So the way that you would set this up is you would click right here, net amount, and you would put in 0.85 because you received $1.70, and that would leave you with a profit of $85. Now, this could trigger anytime well before December, but then that will release the $500 being held for the trade to go ahead and look at a different trade. Now, I want you to notice if you do this, look at the time in force. This is day. So what you'd want to do is do good till canceled, and this trade will continue to work in the background. If it whittles down to 85 cents, then you would be able to exit in profit. It will take care of it automatically. Let's look at a different scenario. Let's look at if the trade works against you. So going back to the original average cost, we received $1.70 when we opened the trade. Now, most traders that do spreads, they like to close these regardless of how close you are to expiration if this doubles in price. So basically, you received $1.70 for it. So if you see that now the price of this option, instead of $1.70, you see that it is $3.40. And that's a 100% loss on the trade. So basically, to get out of it, you'd have to give back the original $170 you got and then dig into your pocket for another $170 to close out the trade. Let me show you what it looks like on a ticket. Now, here we are back at the same starting point for the other one. But this one, instead of closing it out and gaining something, we will be losing something. So the debit here is where you would put this in. If you saw the trade working against you, you would go ahead and put in here $3.40. And at this point, you would see that it's already at that, closer to that point at the midpoint. Now you can see right here, if I were to go ahead and exit this trade, I more than likely would not make it good till canceled. I'd probably just get out of it because at this point it's working against me. You can see I'd take a $170 loss. But that's better than the loss I would take if I just left it open and did not manage it. Now, sure, it may be able to bounce and get away from my strike, but when I lose a setup like this, I like to just refocus myself on a better setup and not obsess over what I could have made on a trade. Now, a lot of brokers will allow you to do a one cancels the other order, and you could set this up automatically. either your stop loss hits first or your take profit hits first and it cancels out the other portion of that trade. Fidelity doesn't offer that, but many popular brokers do. And that's one way that you could go ahead and set up that order right after you enter into the trade. A lot of people, though, worry about stop loss hunting and they would prefer to watch it manually. I usually do the manual watch, and that way I am able to, at that point, decide whether or not I want to exit or if I feel like that there's a chance it's going to bounce based on all the technicals that I'm looking at. Let's go over some ground rules to keep you safe. First and foremost, credit spreads are not set it and forget it trades. Assignment is a real risk, and you don't want to ever leave these open when you are going into an after hours dynamic on the day of expiration. The after hours movement does matter. The market can change dramatically between the close and the exercise cutoff. Plus, I want you to realize that a lot of negative news often takes place after hours, just so the market is a little bit insulated while it's open. You don't want your trade to be vulnerable after market hours. Also, I want you to realize that one break in routine can really have outsized consequences. So the meeting that I was having, not my market analysis, was what created the risk for me. I was distracted. I should have exited the trade before my meeting just to stay safe. I didn't, and I almost paid significantly for that. Although this story has a happy ending, good outcomes don't validate a bad process. Yes, I made money, but that doesn't mean that leaving the spread open was the right decision. If I had to do it over again, I would not have taken the risk. The other thing I want you to understand is how very powerful margin can be and how it can work against you. I like to keep myself safe by ensuring that I don't have more than 30% of margin that's been offered to me tied up in any type of trades, because as volatility increases, then your margin requirements increase as well. So you want to keep that in mind. And then after hour market volatility with margin can really be enormous. So my mistake was not only leaving the trade open, but leaving myself vulnerable to any after hour movement. I hope you found that helpful. I hope it keeps you safe. It's very intimidating when you're on YouTube to actually share such a huge mistake like this that could have been catastrophic. But I reflected on it and I thought this is a great teaching opportunity. And I try to come on here to help others so that they can be a more effective trader. So that's why I went ahead and decided to put out this video and share with you what happened to me so it does not happen to you. Remember, if you're with me trading with Ashley, there is no trader left behind. Now, if you want to watch a video on a different strategy that's a great way to trade and it's more conservative in nature than credit spreads, you can watch that right here.